Wells Fargo mortgage staff braces for layoffs as U.S. lending volumes collapse. Housing in this country is falling further and further by the Fed interest rate hike. Which future will what does the real estate market and banks hold in this kind of macroeconomic situation? In this video we will get to the bottom of this, so stay until the end because what we will see interests you a lot. Let's start. Mortgage volumes at Wells Fargo slowed further in recent weeks, leaving some workers idle and raising concerns the lender will need to lay off more employees as the U.S. housing slump deepens. USA. The bank had about 18,000 loans in its retail origination portfolio in the first weeks of the fourth quarter, according to people familiar with company figures. That's up to 90% less than a year earlier, when the COVID pandemic-driven housing boom was in full swing, said the people, who declined to be identified speaking of internal affairs. The U.S. housing market has been on a rollercoaster ride in recent years, taking off in 2020 thanks to easy money policies and the adoption of remote work, and slowing down this year when the Federal Reserve raised rates. Home buyers have come under pressure, and the pace of refinancing has plummeted as borrowing costs rose to more than 7% for a 30-year loan from around 3% a year earlier. And rates may go even higher as the Fed is expected to raise its benchmark rate again on Wednesday. The situation has put pressure on the mortgage lending industry, particularly companies like Rocket Mortgage, which has prospered from refinancing loans and is expected to lead to consolidation among newer non-bank players that have rushed to serve customers after most U.S. banks withdrew from the market. Among the 6 largest banks in the U.S., Wells Fargo has historically been the most reliant on mortgages. But that has started to change under the chairmanship of Charlie Scharf, who has said the bank is looking to scale back business and focus primarily on serving existing customers. Early warning. In October, the bank warned investors the housing market could slow further after saying mortgage originations fell nearly 60% in the third quarter. We expect it to remain challenging in the short term, Chief Financial Officer Mike Santamassimo told analysts on October 14. We may see a larger decline in mortgage bank revenue in the fourth quarter when originations are seasonally slower. Employees are nervous after the bank began laying off workers in April, and internal projections point to more departures. Local media have reported when Wells Fargo offices have been required to disclose impending job cuts in a municipality. The ranks of mortgage loan officers, who primarily earn commissions for closing deals, are expected to fall to fewer than 2,000 from more than 4,000 at the beginning of the year, according to one of the people. Many sellers haven't closed a single loan in recent weeks, this person said. Another person said most of the departures have been voluntary as bankers looked for other opportunities, making departures and staffing levels difficult to predict. The changes we have made recently are the result of a broader rate environment and consistent with the response of other lenders in the industry, a Wells Fargo spokesperson said in a statement. We regularly review and adjust staffing levels to align with market conditions and the needs of our businesses. The bank said last month that its total workforce shrank by about 14,000 people in the third quarter, a 6% decline to 239,209 employees. Wells Fargo shares are down 2% since the beginning of the year. New home sales in the U.S. fall in September, prices remain high. Sales of new single-family homes in the United States fell in September, and data for the previous month was revised down, further evidence that rising mortgage rates are stifling the housing market. New home sales fell 10.9% to a seasonally adjusted annual rate of 603,000 units last month, the Commerce Department reported Wednesday. August sales pace was revised down to 677,000 units from 685,000 previously reported. Sales fell 20.2% in the densely populated South and 0.7% in the West. However, they were up 4.3% in the Midwest and 56% in the Northeast. Economists polled by Reuters had forecast new home sales, which make up about 10% of the total in the United States, would decline to a pace of 585,000 units. Sales plummeted 17.6% year-on-year in September. They peaked at 993,000 units in January 2021, their highest level since the end of 2006. Data on Tuesday showed house prices recorded their second consecutive monthly decline in August, marking a considerable slowdown in the annual pace of house price growth. Existing home sales fell for the 8th consecutive month in September, while construction also fell, according to reports last week. The housing market has been hit the hardest by the Federal Reserve's aggressive rate hikes, which are intended to dampen overall demand in the economy amid annual inflation accelerating to its fastest pace in 40 years. Mortgage rates have risen even faster. The interest rate on 30-year fixed mortgages stood at an average of 6.94% in the last week, the highest in 20 years, compared to 6.92% the previous week, according to data from the agency Freddie Mac Mortgage Financing. The median new home price in September was $470,600, up 13.9% from a year ago. At the rate of sales in September, it would take 9.2 months to liquidate the supply of homes on the market, compared to 8.1 months in August.